Hello from me, Kevin French. This is Core Wealth's monthly wrap-up. The last one for 2025. We'll have a look at the year as a whole and also at December in particular, where I hope most of you were away for at least most of the time, having some good rest and recreation. 2025 was a really good year, especially for equity markets around the world. The big change, however, that we saw in 2025 was that most of those returns didn't come from the large tech companies in the US. They came from other regions around the world, particularly Europe, UK, Japan was also strong, and then also emerging markets. While some of the big tech companies that had done so well in previous years, particularly in the US, were softer on a relative basis to the rest of the world, we did see some of the tech companies in places like Taiwan and Korea, the producers of computer chips, actually doing very, very well in 2025. The other thing that we saw in 2025, we saw the third interest rate cut by the US Federal Reserve, another 25 basis points, just trying to make sure that their economy doesn't slow down too much. 2025 was a really positive year for the South African stock market, mostly driven by the resource companies, but December was the 10th consecutive positive month of returns on the JSE, and this led to 2025 being one of the best returning years of the last 20. We saw resource companies being driven by stronger platinum and gold prices in particular. We also saw sentiment towards South Africa improving. This also led to a stronger rand, and that strengthened by over 12% for the year. On a macro level, inflation was under control in 2025, and November was one of the strongest months in terms of our trade surplus. In other words, how much we're importing or exporting for the year. Other areas in the market included property, which was actually a bit softer in December, but still had a return of over 30% for the year. So on the whole, a really good year in 2025. So let's have a look at the numbers, starting with global markets, and this is all in US dollar terms. If we just focus on the 1-year number, we can see that developed markets equity still had a really good year, over 21%, but a little bit behind what we saw in the emerging markets, which were up nearly 34% for the year. Bonds and property look actually quite pedestrian compared, but versus inflation, still reasonable returns. The big difference that we saw in 2025 was how the Japanese, European, and UK equities, even Chinese equities, actually outperformed the US during 2025, and strong returns coming from those different regions. So let's have a look at how the South African markets did in 2025. And you can see for the month of December some strong numbers from all the different markets, and then the currency actually strengthening further. So the negative numbers there actually mean that the rand has got stronger and the dollar, pound and euro have actually weakened over that period. You can have a look at the 1-year figures there, but the thing I'd like to just focus a little bit on is if we have a look at the longer term numbers, the 5 and the 10-year numbers. If we look at the 5-year number for the Johannesburg Stock Exchange, 18.8% per year over those 5 years. If we have a look at the South African equity market over the longer term now, over the last 5 years did 18.8%. We compare that to what the US equity market, the S&P 500 did. It did 14.4% in US dollar terms. The rand weakened against the dollar over those 5 years by 2.4%, so that's 16.8%. So over the last 5 years, you've actually done 2% a year better by being invested on the JSE than if you'd have been invested in the S&P 500. Again, we're not suggesting that you don't have exposure globally. We definitely do in all of our portfolios. But what we are just making the point is that it doesn't always mean that one market, i.e. the US, will outperform others. Similarly, if we have a look now at the 10-year number on the Johannesburg Stock Exchange, the all-share index, it's done 12.4% per annum. If we compare that to developed world equity, the MSCI All Country World Index, it's only 0.5% difference between the two, just demonstrating again that it's not always a one-way bet that one indices or one region is going to underperform the other. So let's have a look how this translated into our models. We're going to be very quick on just the comparisons. These tables you probably know if you've watched this before. The section that's highlighted in color just demonstrates green outperformance of our peer group, red underperformance. And 2025, the 1-year numbers, this is our global US dollar strategy, some significant outperformance of the US peer groups, and some really strong returns last year. The global growth strategy, almost 25% in hard currency for that year. If we have a look at the same thing just for our UK strategies over the last year, those returns actually might seem a bit pedestrian, but that type of outperformance consistently through time leads to really strong outperformance and growth in clients' wealth. So between 1.3 and 1.5% ahead of the peer group of the different UK strategies. And lastly, if we have a look at our South African strategies, again, plenty of green on the graph, but interestingly, if you have a look at those one-year returns in rands, our balance strategy, for example, over 21%. Our retirement growth strategy, which I'm going to talk a little bit more about now, 24% up for the year and outperforming its peers by over 5%. What we're going to do, and we'll do this regularly going forward, is now have a look at a particular strategy. And the one I'm going to focus on today is our retirement growth strategy. Our retirement growth strategy was launched in November 2013 and was focused particularly on providing an investment strategy for investors saving for retirement. Importantly, most retirement savings are long-term savings. Imagine if you're in your 20s and you start saving towards retirement, it could be 40 years before you want to draw on those funds. Even somebody who's closer to retirement, their investment holdings are not going to completely change the day that they retire. They're still going to live past their retirement date, possibly for another 20 or 30 years. Because this is a retirement strategy, it has to comply with Regulation 28, which means that it can only invest up to 75% in equities. There's also a limitation on how much can be taken offshore, a maximum nowadays of 45%. What we are targeting in this strategy is aiming to try and generate as high a real return as is reasonable given some of those regulatory constraints. And so the target is to generate returns of inflation plus 6 over the longer term. So the graph shows us how this strategy has performed over the last 13 years. The red line is just saying what inflation has done. Green is saying if you'd have invested R1 million and just put it in a money market, that's what cash would have given you. It would have grown to 2.2 million. Compared to our competitors, the peer group average would have grown to 3.2 million. This strategy over that period has grown your 1 million to almost 4 times what you started with, up to 3.7 million over that 13-year period, outperforming its peers and outperforming the real return target that we've set. One of the things we spend a lot of time and resource on is understanding who's good at what, and we use those managers in our portfolios. Allan Gray Orbis is a manager that we use for some of our global mandates, and the global portion of retirement growth is actually, part of it is invested with them. The Allan Gray Orbis Global Balance Fund has been around since 2004, so a 22-year track record. And you can see in the graph there, the purple line just showing how it's done relative to its peer group, and was kind of tracking it for a very long time, and then we saw it really move ahead during 2022 and onwards, outperforming the competition quite strongly. The most recent year, we've just shown you 3 of their biggest holdings, 2 of them giving significant outperformance, and that was Samsung Electronics and Taiwan Semiconductors, just on the back of what we spoke about in the introduction of globally the non-US tech firms really having a strong year last year. So there's 2 constraints around the asset allocation, what we can have the underlying investments invested in. We have limitations in terms of regulation, which I spoke about earlier, and we at the same time are trying to maximize our growth asset exposure. And what you can see if you just look at the bars on the far right of this graph, our total equity, the purple line, just under 71%. Well, that's 9% ahead of what the competitors are at. We've done that because that's where we believe we get the long-term growth in these portfolios, and it's definitely been the case. Then the other factor is that we're underweight offshore relative to our competitors. And that's just simply been on a valuation basis. We've seen much better value in South Africa, and as I showed earlier, that has definitely paid off over the last 5 years. So we're going to have a look at what we're expecting in the coming years from the South African economy and the South African stock market. And let's start with the South African economy. Since 1994, we've had really two distinct periods of economic growth in South Africa. From 1994 to 2008, we saw some really dynamic things happening. We saw the commodity boom take place, and we had average growth in South Africa of 3.6% per year of economic growth. For the next period was actually not as good. This started with the global financial crisis, a shock to the economy, but then particularly poor governance starting under Jacob Zuma, where we saw economic growth only growing at 1.1% per year. If we look ahead, the International Monetary Fund is projecting that South Africa will grow at 1.5% in the coming 5 years. We think that's probably a good baseline, but there is a possibility, just given some of the changes that we've seen, that we could exceed that. For us to make a real dent in our unemployment in South Africa, we need to push that number up to north of 3% and ideally closer to 5%. One of the levers of control that the government has via the Reserve Bank is monetary policy, what they do with interest rates. And these two graphs, just on the one on the left, just shows you how interest rates have gone up. And following July 2023, where our interest rates were at a peak at that point in the cycle, have now come down. Those reductions in interest rates should be supportive of economic growth, as any company with debt or even individuals with debt are paying less interest on those debts. The further easing, we're expecting another 25 basis points or 0.25% cuts in 2026. And again, that should be further positive for economic growth in South Africa. The reason the Reserve Bank has been able to cut interest rates is because inflation has been brought under control quite well in South Africa. So when I spoke about economic growth at the beginning of this section, I said that our GDP growth had kind of flattened since 2009. The same cannot be said for earnings of the companies on the Johannesburg Stock Exchange. While there was a flattening, and if you have a look at the graph on the left here, strong growth from 94, and then from 2009, still some growth, but relatively flat compared to that first period. Since 2020, we've seen earnings from the companies on the JSE pick up really quite strongly. Some of that has been on the back of resources, but a number of the other companies, a lot broader, have managed to grow their profits. And looking ahead, 2026, the expectations for profit growth is 31% if we look at the Johannesburg Stock Exchange as a whole. So healthy profitability within the companies. So the earnings is one side of the coin, but the other side of the coin is what do we have to pay for those companies to buy those earnings? And if we look at the moment at the South African stock market, one of the ways of looking at companies is looking at a price earnings ratio or a forward price earnings ratio, taking into account projected earnings. And the graph on the left hand side just shows you that the South African stock market, the forward price earnings ratio has gone up over the last year, and that's because we've seen such a strong run in the stock market. However, how does that compare to other stock markets around the world? And on the right-hand side, we're just showing all the different stock markets, what their forward price earnings ratio looks like relative to the S&P 500. And we can see there that South Africa has one of the biggest discounts. So the bigger that line, South Africa's is 11.2 times, that means that our stock market is way cheaper than what we're seeing on the S&P 500. The previous section, big tick, earnings growth looks positive. This slide is just showing us that we're not having to pay expensive prices to buy those shares, and that makes it a very attractive investment. Let's have a look at the bond market and the currency market. And this slide just shows us on the left-hand side the bond market relative to its peers, saying what is the return above inflation. And we can see there that the blue section showing you what that real return is. And for South Africa, there's still a real return on our bond market of 4.6%, 4.6% ahead of inflation, which is really healthy. And there's only a couple of countries that have stronger real returns on their bond markets. And this is after we saw last year that our bond market was up over 24%. So big tick on the bond market at the moment. The other one is on the currency side. Projections on our currency, they varied on different mechanisms. Suffice to say, at the moment, our currency still looks too weak. There's a reasonable possibility that, especially with the resource sector doing so well, there could be more demand for South African rands, which could make the rand go even stronger than it is currently. This slide just summarizes everything that we've just said. We're cautiously optimistic overall. Economic growth has improved, could still improve further, but better than what we've seen. Interest rates are going to continue to come down. We expect 2.25% cuts in the South African interest rate cycle in 2026. Our equity market is still cheap relative to its own history and to other countries around the world, and earnings are looking strong for 2026. The bond market has got a 4.6% real return built into it if you buy the 10-year bond at the moment, which is very attractive. And lastly, the rand is still looking overly cheap, so we could see the rand strengthening further, which would be good for inflation. And in fact, it will probably be driven by the commodity cycle continuing to strengthen. So once again, we hope that 2026 is a great year for you. If you have questions, by all means, give us a call or drop us a message on the social media feeds, and we'd love to engage with you. We look forward to seeing you this year. All the very best.